What we're seeing right now, especially in the last 2 years, where you probably know this better than I do, but it's been a pretty difficult time for startups and investors.
No doubt.
And you see a lot of investors start to pull back in this difficult market.
Hello, everyone, and welcome to the very first Data Minute podcast. My name is Peter Walker. I'm the head of insights at Carta, and I am so thrilled to be bringing you this weekly insight show driven by Carta's unique position in the U.S. startup ecosystem. Now, we've been digging into startup data for more than a year in our Carta Data Minute newsletter, and we thought it would be useful to bring on some of the smartest and most thoughtful people we know across venture capital to give you some perspective on the numbers, whether you're a founder or an investor yourself. And on this very first episode, I was thrilled to be joined by Dave Anderson, managing partner at Beat Ventures. Beat Ventures is an early-stage VC firm that's focused on investing in companies that use AI to enhance humans in overlooked and legacy industries. Places like meat processing, manufacturing, everything that needs a little bit of AI love that just isn't getting it here in Silicon Valley. I was so incredibly excited to have this conversation with Dave, and I'm equally excited to have you listen to it. Let's jump in. Dave, thanks so much for joining me, man.
Thanks for having me, Peter.
I'm super excited to listen to what you have to say about how early stage investment is going. We are actually just having a conversation off mic a little bit about leading versus following. So it's something that we get asked a lot is how do I find a lead investor? But your firm is exclusively a follow-on check to these pre-seed, seed rounds. So like, how does that work?
At least right now, we're a follow-on check. Yeah. At some point in the future, after we raise Fund 2 or Fund 3 and so on, then we might start to write some lead checks. But as of right now, we exclusively follow and we look for a strong lead investor. I think it's important for founders to really consider the type of individual investor that they're partnering with for the next decade.
Right.
And so you want to find that partner that's going to be able to support you through the good and the bad times. What we're seeing right now, especially in the last 2 years, where you probably know this better than I do, but it's been a pretty difficult time for startups and investors.
No doubt.
And you see a lot of investors start to pull back in this difficult market. We've leaned in. Because we want to be the most supportive to our founders during this difficult time because we still believe in them.
Right.
So I think it's important for a lot of founders to keep that in mind at the gate as they're looking for lead investors.
And do you recommend, it sounds like in order for you to be an investor in a company, they've already got to have an established lead for that round. So are those fundraising, like are those parallel tracks where they're talking to you in hopes of finding the lead and then, sort of consummating the relationship with you all? Or is it they should get the lead first and then you can come and
it's usually a bit of both.
Okay.
So we like to meet founders very early. So a lot of times we're meeting them well before they have a lead investor or in some cases before they even have a settled on idea. In some cases we will help them refine that idea. So we're not scared to engage at that point. That doesn't necessarily mean we're going to write a check. But we do meet them very early. And so what we will typically do is engage, build conviction around the founder, help them refine that idea, and then say, hey, we can introduce you to a few investors that might lead. When you secure a lead, you can count us in for X amount.
So it's like conditional on the lead, but you can also be a pathway, a network to the lead investor in the first place.
Absolutely. Yeah, we have a number of lead investors that we've worked with closely. And we've become, a feeder, for lack of a better word, into some of those lead investors.
That actually fits really neatly with, so we're going to show a couple of charts in this episode on what's going on with early stage safes in particular. And I thought the one that was kind of fascinating that you and I had been chatting about before was how many checks per round a founder should anticipate for each kind of safe round. So kind of to give people a sense of it, you can see it jumps up from like 3 or 4 checks for $250K to 8 to 10 checks if you're going to raise $500,000. Or even to 12, 14, 15 checks if you're raising more than that. And it sounds like the best way to understand like how many of those checks you're going to need is to establish the lead first. But do you see founders taking a completely different fundraising path? Or is it always get that anchor and then go and fill out the rest?
No, I've seen all of the above, and especially at the earliest stages. So I'm talking pre-idea, pre-company formation.
So they haven't even incorporated.
That's when I love to meet founders because I can hopefully have some type of influence on the company that they go on to create. Not to say that I am the end-all be-all. I do not believe that. But I do like to give my perspective in case it's helpful to help craft that idea. And so at the earliest stages, a lot of them are just figuring out, unless they're a second or third time founder, which I do, appreciate.
Sure.
Unless they're a second or third time founder, they're often, trying to figure out, how do I even fundraise? Who do I talk to first?
Right. Yep.
And so there's a process that a lot of them go through where they might meet a few investors and get some of those early, maybe it's someone that they worked with in the past.
Yep.
Right? Get a few angel checks that could be value add.
Yep.
And then start to have those conversations with lead investors. But that takes time.
Yep.
And we can plug in at any point in that process.
So I know that you all are Silicon Valley based, SF based, but then also have now a partner in New York, which is pretty fantastic.
Yep.
Do you see the fundraising process at that very, very earliest moment being very different if you're not in Silicon Valley or in New York? Like, how different is it? It's what does it mean if I'm in a non-mature VC ecosystem?
Yeah. So I'm based here in San Francisco. My co-founder, Colin Rochester, is based in New York.
Yep.
And so we have pretty good coverage between San Francisco and New York, but we look all across the country.
Yep.
For the most part, we focus predominantly on the U.S.
Mm-hmm.
We will look at some international deals, but that's not a focus of ours at all. You can call it like 3 to 5%.
Okay. Yeah.
And so what we see is that in these ecosystems like San Francisco and New York, there's just a different level of savvy around fundraising.
From the founders or from the angel network?
I'd say from both.
Okay.
There's a different level of exposure because a lot of them have friends that have gone through the process.
Yes.
Or they have someone that can kind of teach them the ropes as they're going into a fundraise themselves.
Yeah.
Whereas as you get away from these clusters, then it's a little harder. It's not to say that there's not successful founders. I'm from Detroit, Michigan.
Right.
That's not necessarily known as a startup hub.
Sure.
But there's a startup community there.
Yep.
And there are some successful companies that have come out of there. But in terms of likelihood and the types of founders that you're going to, on average, run into, you're more likely to run into a founder here that understands the fundraising process from start to finish versus in some of the areas outside of clusters.
And do you think that founders who find themselves not in the Valley, not in New York, there's been a lot of talk about how, we hear it from Gary Tan all the time of like, move to SF if you want to be part of this sort of magic moment with AI and the ecosystem and everything. Do you have a strong opinion on where founders should be? Does the location really deeply matter at that early stage?
I largely agree with Gary.
Okay.
I do love to see, I mentioned the word clusters.
Yeah.
I believe in these clusters where you have a good point of critical mass of founders and VCs that are running into each other at a bar or at a restaurant or working out at the same co-working space. Like that is where innovation happens. And that's what bums me out around remote work so much, and I hope that we eventually move out of remote work. Not to say that, in some cases that does work.
Sure, it's not like a blanket statement. Yeah.
I would much rather see my founding teams be located. It doesn't necessarily have to be San Francisco, but San Francisco still has a lot to offer founders in terms of talent, in terms of access to capital, programs like Y Combinator. So it's not a blanket statement, but I do largely agree that you need to be where your co-founders are. Yeah. But more importantly, you need to be where your customers are. Yeah. And that kind of leads into a big focal point of ours. We tend to invest in these industries that are overlooked by Silicon Valley. Okay. And so that means that they might be located here, but traveling to where their customers are in Michigan or in Kansas, North Carolina. Okay. So there's a balance.
But you still find value in them not founding the company necessarily, but building it here and then doing those excursions to their customers on a consistent basis.
Absolutely. Okay. And there's a bunch of caveats that I could throw in.
Sure. Yeah.
But largely I would say you want to be in a cluster. Yeah. You want to be around other smart people, other good builders that you can trade information with, that you can innovate with. Mm-hmm. I think SF is still one of those super clusters that you want to be in.
I mean, based on our data, it's absolutely the case. SF has, I guess the way that I would put it is, it is easier to start a company anywhere, but the actual relative lead for the Bay Area versus other investment locations in terms of overall funding, chance of being funded, like at various stages is still holding pretty relatively high. Yep. It hasn't actually been diminished. Other ecosystems have just risen up to a level of you can get off the ground here much, much more easily in places like Austin or Charlotte than you used to. but it's nothing like the Bay.
I mean, I often point to the chart that you showed me that you created of the top 10 startup ecosystems.
Right. Yep.
And San Francisco is number 1 or number 2 in all of them.
All 10 industries.
Yeah, all 10 industries.
Yep.
And New York, I think, is number 2.
Yep. Very strong, number 2. Boston, pretty close, number 3. But like, it's the places you think.
And there's a reason for that.
Yeah.
Right?
Yeah.
And it's been that way for a long time, and I don't see that changing anytime soon.
So the other point on the density of like a startup cluster, to use your words, is to me about like, what do rich angels do with their money? Mm-hmm. Like if you're in Dallas and you're a wealthy, high net worth person, perhaps you spend your time in real estate investing or you're doing other things with your cash. If you're in Silicon Valley, it's a high likelihood that you're doing some form of angel investing. So like, how do you compare the angel networks in like places across the country that way?
Yeah, I mean, so pointing back to my hometown, Detroit, like there are a bunch of angel networks and they're active, but a lot of angel networks in Michigan want to touch and feel their investment, and so it's not necessarily going to be largely software based. They might want to see hardware that's produced. Yeah, they can see the specific ROI.
And with some like tangible something.
Tangible. And so a lot of what is produced in Silicon Valley hasn't traditionally resonated with those angel networks. I think that is starting to change because information spreads more widely and faster. And so you can see a lot of success stories all over the world of, great companies coming out of Utah and Michigan and all these places that aren't necessarily known for that. Yeah. But yeah, I mean, I think the angel networks here, you've most likely made your money in a software company.
For sure. Yep.
And so if you've made your own wealth in software, you're likely to put your wealth to work in companies that look like the ones that you've built. Yep. So I think that's one reason that we start to see the angels more active in those areas.
And as a follow-on investor, do you also find that Silicon Valley is an easier place to like establish your relationships with the lead co-investors that you're going to need to have? And it sounds like you have a roster of people that you love to invest with or invest alongside.
Yeah, I think it's extremely important because building a relationship it shouldn't be transactional. Yep. And I do not feel that way about the relationships that I have. Right. And there's a lot of people that don't like being immersed in this business atmosphere 24/7. Right. I do. Yeah. Because
you do feel it in us.
I truly love the work that I do. Yeah. And I like to have genuine relationships with folks like yourself, right? Like, I think we may have met in a business context.
I think so. Shack 15, perhaps.
Yeah, exactly. Yeah. But it feels more friendly, right? And I've gotten to know you as a person. Yep. And I feel that way about a lot of VCs and founders. Yep. Just to run into them at Shack 15 or run into them in my neighborhood. Right. My neighborhood has a lot of founders and VCs. You could get to know them as people before you get to know them as a founder or an investor. Right. And that's, I think one of the benefits of being here.
Yeah. So I guess the second chart that I wanted to dig into is all about the difference in valuations between California and all other states. And we can chat about various kinds of valuations. So in this case, we're talking about how in a safe round or a pre-seed that's being done on safes, there's usually a valuation cap applied to that business. Not technically a valuation, but kind of a stand-in. And there's a consistent pattern of, like, for instance, if you're raising a pre-seed round on safes of about $1 million in California, your median valuation cap is going to be something like $10 million, whereas most other places in the States, it might be $8 million or even $7 million. What do you think of that premium? Do you think about that entry point as very difficult for you, or do you think that premium is generally worth paying?
Yeah, it depends on the company. It depends on the tech that they're developing, the industry that they're in. There's a lot of caveats, but I would say that it ties very nicely into the discussion we just had around this being a super cluster. Yeah. There's a reason that people are willing to pay a premium, right? Like, this isn't really unique as far as I understand. There's always been a Cali premium. Yep. Dating back to probably the 60s when Silicon Valley was first emerging.
Fairchild Semiconductor, the whole thing. Yep.
So... I think that that premium has always existed, and to my knowledge will probably continue to exist for the foreseeable future. I would start with things that are a little more practical. Cali's an expensive place. Sure. Right?
Definitely.
If you're going to build here, that you're going to pay on average higher rent. It's going to be more expensive to hire the right talent, even if they're worth it.
Yep.
It's more expensive to go out for a beer or,
For sure.
to go out to lunch.
Yep.
So those are all these practical things that founders have to grapple with.
Yep.
I think another reason for that premium could be, you're often dealing with very experienced founders. Right.
True.
So they might be graduating from a successful exit. Maybe they weren't the founder in that company, but they were an early employee.
Yeah.
Maybe they did found a successful company before, and so they know the ropes. And I'm willing to pay a premium for that.
Right. Yeah.
Because there are a lot of risks that come along with funding a first-time founder.
Yeah.
I am willing to jump in, and I have funded first-time founders. But I am willing to pay a premium for someone that has a little bit more experience.
I think that level of institutional knowledge, we saw, I think it's one of the biggest sort of hidden trends of the last year is just a reversion to the preference towards repeat founders or people who've been there before, just because if the risk is higher, if, money is actually more dear with interest rates being what they are today, it makes sense that you would kind of revert to a little bit more people who've done it before, people who've had successful exits, or even people who have deep knowledge about VC and startups to begin with. And when we run across founders who are first-time founders and they say, look, I have more traction in whatever way they want to define it than this repeat founder, but the repeat founder gets a better deal than I do, it always comes down to that like institutional knowledge is just being priced at a very high premium.
Yep. Yeah.
Do you find to take that another way, a lot of that premium to these days is talked about when we talk about graduates from these accelerator programs, YC being the most important one. We're about to have another YC demo day here in San Francisco, and there's this constant conversation about if those companies are quote unquote overvalued. What are your thoughts on like the companies coming out of YC and whether or not that premium is justified?
Yeah, there's definitely a YC premium. I think a lot of it is justified. I like YC as a program. I've invested in quite a few YC companies and will continue to. I'm really excited to look at this next batch. With that being said, I don't think it's always justified.
Right. Sure.
And look, to my knowledge, YC isn't the one setting their terms, right? It's the founders that are setting their terms.
Sure. And
I see inflated valuations outside of YC all the time. So I wouldn't necessarily ascribe this to YC.
Yep.
But if you're coming out of a good educational institution, right, and you are in the market for a job, you're going to think that you can fetch a higher premium than someone that was at a lesser institution.
Yep.
And I think it's very similar.
Yeah.
So YC is a brand that has created some amazing companies through the years.
Totally.
And so if you're associating yourself with that brand as a founder, chances are, that premium is justified. It's just how much is it justified?
Right. Yeah.
So I don't know, maybe you have data on specific.
Typically we see YC taking anywhere from a 30 to 40% premium if you just look at the valuation caps. Yeah. Now, that's really difficult because I don't know at what stage. The way that some people have described it, which I think is a really good way to think about it, is that YC, when you exit YC, you are in at least name, but in also practice in many cases, a seed stage company.
Yeah.
Like you've kind of skipped pre-seed.
Yeah.
Even if your company's only 6 months old. Just because effectively with the network and everything, you're going to be at a certain level.
Yeah.
And many of those companies fail. It's not as though the modal outcome for a seed stage company is still going to zero, right? These are startups and they're really hard. But I think that the premium is kind of justified if you think about it that way versus this is a 6-month-old company. The idea that they're worth $20 million already is kind of...
and that's super problematic.
Right.
It doesn't do anyone any good for the company to be overvalued.
Right, true.
Especially at the pre-seed or the seed stage.
Yep.
Because what founders have to keep in mind is that they want to, be able to raise that next round.
Yeah.
Unless you're planning to raise one round and then, IPO or get acquired.
So that's to that idea. Are you running across more founders who are saying, my goal is to take in $1 million, $2 million, $3 million in funding and then stop funding?
That's an interesting question. I'd say I've been expecting to, but I haven't.
Interesting.
And the reason I've been expecting to is because AI does provide access to tools to run your company more efficiently.
Yep.
And perhaps not hire as many people.
Yep.
And so I am expecting to see, some founders go out and say, I'm not going to really hire anyone.
Yeah.
Like everyone's been talking about like the 1-person unicorn.
Right. The Sam Altman.
Yeah.
When will there be $1 billion company?
And that's likely to happen at some point.
Sure.
But I haven't seen it yet. I think people are still infatuated with the idea of raising a lot of money.
Interesting.
I just haven't come across it. I look at 1,000 companies a year.
And it's not even in the pitch. Like no founder is actually suggesting to you, like, my goal is to take your check and maybe one other check, and that's it.
Haven't heard it yet.
Interesting. Do you think you're just not seeing them because they're bootstrapping anyways, and they're just kind of not talking to any VCs?
It's possible.
Right.
It's just, and I'm not saying that they're not out there.
Sure.
I just haven't personally been pitched that yet.
Yep.
I certainly expect to come across a company like that. Although the one counterpoint is if you're a savvy founder and you understand the VC landscape and how VCs are measured, it's not necessarily appealing to most VCs to say, I'm going to raise this one round of capital and then never raise money again, because then you can't mark up your book.
Definitely not.
Yeah.
It's not just a challenge on the founder side, which is, can you get to venture scale with very little capital? That's always, like, there are amazing bootstrapped revenue funded businesses.
Yeah.
They just didn't take venture money, and they grew at different rates most of the time.
Right.
The real question is for VCs, like, that is not, as you mentioned, that attractive a proposition. If I get no markups on this thing and then a dozen years later I have an exit, there's a wide gap in the middle there where you don't really have any say or control, or you can't show any change very often.
And that's, I'm not saying that's a good thing.
Right.
DPI, distributions are king.
Right.
And we need to always, as VCs, keep in mind that we should be after distributions at the end of the day.
Yep.
But the unfortunate reality is, if you are fundraising and you don't show markups via TVPI,
yep.
Then it's going to be a hard road ahead.
Yeah.
So, I think it's something that VCs should keep in mind.
Definitely. I do think that there's going to be companies that try this revenue fund a little bit route, but in some ways, even the instruments that are standard now for early VC companies are not incredibly well suited to that sort of approach. I'm thinking specifically of the SAFE here. If you fundraise on a SAFE and never take priced equity, it's really just a trust thing, whether or not that's going to convert into the company, actual equity in that company. It's just a trust between you and the founder.
Yeah, and I've heard horror stories.
I've heard a couple myself.
Did not convert.
Yep.
And
sure.
There's nothing obligating that founder to convert that.
100%. They were like, thank you for that grant.
Exactly.
Early cash. Like,
I think that's a huge hole in the entire, SAFE methodology.
It is. Do you only use safes these days on your investments? Or
we do a lot of safes.
Okay.
It's not only safes. But I think, look, that was another YC creation that has benefited the ecosystem and especially investors like myself and early stage founders, where we don't necessarily have to involve and pay these exorbitant legal fees to get a deal done.
Sure.
And so I think that there's definitely a lot of benefits, but that's one big hole that's been exposed.
I do think the SAFE has sort of achieved this level of prominence that now it will start getting the backlash from being like this standard thing. I've already heard it from some investors who are saying, yeah, it doesn't provide me enough rights.
Yeah.
There's not enough guarantees. So like, I prefer a convertible note because whether or not I actually end up charging this company an interest rate, which most of the time they won't, this is a tiny company, at least it has a maturity date that I can force a conversation about something down the road.
Yeah.
Whereas a SAFE, I may just be out of luck and that company closes down and I don't even have the chance to talk to them.
Yeah, I think if you're worried about a founder screwing you over later regarding a SAFE, you probably have bigger problems that you
right. That's maybe not the best investment strategy. Yeah.
So I like to think that the founders that we're investing in aren't going to do that.
I would hope so. Yeah.
Fingers crossed we never have to cross that bridge.
Right.
But yeah, I mean, look, we are definitely seeing market conditions shift slightly in favor of the investor.
Yep.
I haven't seen any, 2x lick pref or, anything that's, too overly.
There's some out there, but it's actually less than some of the horror stories might suggest. Like across Carta, high liquidation preferences over 1x, it's about 6 to 8% of deals.
Okay.
Definitely not nothing, but it's not, and it hasn't radically shifted over the past 2 years. I think most of what's happening, you could either ascribe this to the optimistic point of view, which is founders and investors are treating each other with respect.
Yeah.
Or you could ascribe it to the deals that would have been at those onerous terms just aren't getting done.
Totally.
And like there's more, and we're seeing that now with like companies shutting down, there's just more deals that are just not happening.
And to tie that into the previous conversation about the California premium,
Yeah.
I think that transparency has a lot to do with that. So the fact that you're doing these deals more transparently,
Yep.
I can look to Peter Walker and say, what is the average deal getting done at the pre-seed or the seed?
Right.
Kind of allows more respect between founders and investors, and I love that. And to continue to add on to that, I think one other dynamic regarding the California premium is just the fact that you have a lot of people bidding for the same asset.
100%.
Right? And that asset is non-fungible.
Yeah.
To use an overused term. Like if I'm bidding on apples, right? And I can go and buy, why would I pay $1 for, an apple from you when I got to pay 75 cents from someone else, right?
Yeah.
Because I can, apples are tradable.
Yep.
But with, I like to think about it like art, right? If I'm at an art auction and I want that piece of art, I have to bid on that art and there's going to be other bidders.
Yeah.
And I think there's a lot of similarities here in the startup ecosystem in California versus somewhere else where a startup might have to take the only offer that they have because they don't have a large network of investors.
I think that's a great way to describe what I've found as one of the consistent misunderstandings from early stage founders when we talk to them is that a lot of times, especially at pre-seed or seed, the valuation of the company, even the val cap on a safe, it is not as much an intrinsic reflection of what is this business actually worth today. Right. If you were to do a nuts and bolts evaluation, it is a function of supply and demand.
Totally.
And obviously vision towards the future, but supply and demand, maybe even first and foremost before anything else.
It is by definition more of an art than it is a science.
Absolutely.
Because you're not really, you're not valuating anything.
Right. What financial statements can you evaluate?
Yeah. I mean, to some extent, I guess all valuations are a bit more of an art.
Well, that's philosophical.
Yeah, it's a bit philosophical, but it's causing you to take a stand on what you believe about the future.
True.
In every case.
Yep.
It's just with later stage companies, you don't have to predict the future as far out.
Yeah.
And with early stage, you're asking me to predict the future, decades into the future.
Yeah.
And I don't have a science around that. I can't predict the future. Can you?
No. We're trying.
So, I think, a lot of what we do is valuing companies where there's very little to value outside of the founder.
So that brings me to the final point that I want to talk about in terms of valuation and the premiums on things. You and your partner, Colin, are deeply involved in investing into these AI companies, maybe slightly different kinds of AI than some of the gen use cases that we're used to seeing now. What is your opinion on how frothy the AI market is and whether or not you see like different forms of fundraising approaches or pitches from AI founders versus non-AI founders?
Yeah, I mean, it's hard for me to argue against the market not being frothy.
Sure.
When I look at NVIDIA, which is an amazing company that, has increased in value, I believe I just read 250x since 2013.
Pretty crazy.
It's crazy, and a lot of that has occurred in the last year or two.
Yep.
So they're doing a ton for the AI ecosystem. But what do I have to believe about NVIDIA to justify the valuation today? Right.
Yeah.
So I can't put a number on it, but I would bet that they're probably overvalued. I don't know.
Sure.
And so now kind of back your way into AI startups, right? They're benefiting from this AI hype cycle, this AI craze. And there's definitely an AI premium to talk about another premium that exists.
Sure.
And look, I'm a believer in AI. I have been since 2018 at the very least, since I've been investing in this category. But the unique lens in which we view AI companies is not the sexy companies that you're going to see in the headlines over the last year. We think that those companies, there's obviously a lot to them in the video imaging spaces and the foundation models.
Yep.
But we tend to focus on the application layer and specifically on industries that are traditionally overlooked by Silicon Valley. So think manufacturing and meat processing and software for electricians.
Right.
And, those may not have the $100 billion outcomes.
Yeah.
But we're investing, at like a roughly $10 million valuation, right?
Yeah.
And we'd be really happy with a $2 or $3 billion outcome.
Sure.
And so we tend to look at those industries and try to identify the best founders with exceptional founder market fit, which we think is extremely important in this market, and fund them at the earliest stages.
And do you run across, like, as the percentage of pitches that you're getting from the 1,000 or so companies that you meet, what percentage have AI as part of the core pitch these days?
I was at a gathering yesterday, and one of my friends introduced me to this founder that was sitting next to me, and he said he's building a company. I don't know if it has an AI component. And the guy, the founder sitting next to me said, well, now it does.
Right, yeah. As of this meeting, no problem,
And, that's kind of a funny anecdote to, kind of just show that, like, I think in order to raise venture funding from a lot of VCs, you have to have an AI component. And it's incumbent on us to extract whether or not that company actually does have an AI strategy. But I'd say easily for the companies that are pitching me, it's a part of the bat signal that I put out there, and the companies that I attract, it's easily 80 to 90% have an AI component.
And that's we are seeing there is an AI premium from the data, no doubt, in terms of higher valuations and more cash raised per round for these AI companies. And then there are more companies who have either adopted AI as part of the strategy or like refashioned themselves as AI companies, which people kind of poo-poo sometimes, but I think is a perfectly reasonable, like, pivots are happening all the time in early startups. Like, why would you not do that if you can harness a part of, like, the tech wave?
It's kind of like building for the internet and then seeing mobile coming on the horizon and saying, I'm going to avoid mobile as a...
Right. I'm an internet company, not a mobile company. It's like, that would be silly, right? Yeah, I totally agree. But I do think that the AI, what I'm really interested in is AI is even more of a cluster story than the rest of venture. So AI feels incredibly clustered, not just in Silicon Valley, but even in San Francisco proper. And we're seeing that in some of the data, and I wonder if there will be a democratization of AI companies or if there's going to be an even more concentration here, New York, and like a couple other places.
That's really hard to predict. I think in some respects, AI has already been democratized. Anyone can tap into OpenAI.
Sure.
Right? Start building on GPT-4.
Right.
And it's relatively easy to do that. And so if you're just trying to build a company that utilizes GPT-4 and you build a quote-unquote wrapper on top of that, that has already been democratized. It's just the speed at which you're able to take that wrapper and develop your own models or take it to the next level. I think it's happening here uniquely, and it's not necessarily happening in other places that I'm seeing.
Yeah, I'd agree with that. And I'm glad you didn't use the term wrapper in a derogatory way, because
I don't think it's think it's a bad thing.
I completely agree. I think it's exactly what you want founders to do. To tap into all available technology. Then if they have an unfair advantage in distribution or customer preference or experience or UI, like, that's how they can bring that to bear.
I'm not necessarily just going to invest in a wrapper.
Sure.
Right?
Definitely.
I mean, there are other things that I have to evaluate.
Right.
But I don't necessarily think that my knee-jerk reaction to a company building a wrapper, at least to begin, should be a bad thing.
Well, Dave, I super appreciate the time. Any last words on what you're seeing in early stage fundraising at the moment that you, or a word of advice to founders who may be listening in?
The market is really weird right now, to use a scientific term. I think that there are actually, it started to heat up in the last 4 to 6 weeks, but it's still taking on average a longer time for founders to raise that first round. So my advice to founders is stay diligent, stay resilient. If you believe in what you're building, stick to that conviction, and the money will follow.
Well said. Cool. Thanks for joining me, man.
Thanks for having me. Appreciate it.